go back to 2010 and you will not be able to imagine that the government will be able to build all kinds of digital infrastructure in 10 to 12 years. Now let's go through a life cycle of somebody wanting a loan, right? Somebody needs a loan, they decide to share data in a traditional world. These are physical documents. They will have to send it to different companies, so multiple sets of the same documents. These physical syndicators, by the way, one of their primary jobs, why they exist, is to print documents in multiple copies, right? Like they have this photocopy machines installed at their small office, and all they're responsible for is making sure you make 5 different copies because the loan is going to go to 5 different companies. So they are doing that grunt work of getting multiple loan offers. You accept the best offer, you receive the loan, you decide to use the money, and then you repay the loan. That's the typical life cycle. Now, I'm not going to go into too much detail on how this would work in the traditional world. Everything is physical. Everything is like on paper. So, there's no point discussing it. But let's talk about the important pieces of technology that have come in at each of these steps, right? So when it comes to needing a loan, the first thing you need to do is identity, right? That's being solved through Aadhaar and eKYC. Then there is agreeing to share data. We already spoke about account aggregators. That's how data is going to be shared. So data empowerment has happened where you're truly in control of your data, and you can decide who has access to your data, and you can pull back access, you can give access and whatnot. Then there is seeing loan offers. This is going to be done on those open credit enablement, credit marketplaces that are backed by APIs. So multiple APIs. In 30 seconds, 1 minute, you're going to get loan offers that used to take 14 days, 15 days, 30 days in some cases if the file was complex, right? Then accepting the best offer. All of this was done digitally. You've signed a loan contract, 100 pages of just like signing, sign here, sign there, sign cross, sign like on the sides, sign at all kinds of places. It's
the most annoying thing in the world, man.
And now
I recently increased the limit on one of my companies. I think I made 100 signatures, and then my accountant always complains that my signature doesn't look the same on every page. So it's so annoying.
As I said, I used to work at a lending company, and come month end, everybody was under the pressure to meet their targets. And the worst thing that could happen on the last day, one of the signs don't match, right? The sales guy used to throw like a fit, like you're not going to let the loan pass because that one signature doesn't match up. And by the way, it's not like these, people who are processing these loans want to just be mean to you. It's because frauds happen. A lot of frauds happen, right? Digital syndicators used to sign on behalf of the company because their incentives were tied by the bank on the number of loans that they were approving, right? So all kinds of misaligned incentives led to a lot of frauds. So e-sign is going to be...
I just have one funny story over here. One day, my accountant got so annoyed with me because my signs didn't match. I think I'd just come back from vacation and I had not signed anything in a month. She made me spend a solid 10-15 minutes, gave me a piece of paper. She just made me sign like I think 50, 60, 100 times just to make sure that all my signatures are the same.
Exactly. So for people who've either taken loans or who've been in the lending industry, these physical signatures are a pain. That will be replaced in the near future by e-sign. So that's another piece of technology that's come out of the India stack or India digital infrastructure. Things that we've been doing. Now receiving the loan, which is the next step, that can be done through UPI. Selling goods and repaying the loans can be done through e-mandates, which is automatic deductions at a certain period, or automatic deductions if a certain company gives you a loan. Those kind of mandates can be done, and then this entire process we've been able to do digitally, right? There could be Aadhaar enabled payment service instead of UPI. There are multiple sort of things that you could do in terms of alternative technologies that have come out, that have been built already. And I keep saying account aggregators was that missing puzzle. We are full throttle into that process of getting the large institutions on the account aggregator framework. And once that happens, is the era of embedded finance, or what Kunal Shah likes to call lending as a feature, is going to truly kick in. What's going to happen is this. It's not going to be policy or Paisa Bazaars type of companies that will come in and say that, hey, we are going to give you loans. There's going to be a very important player in this entire thing that we've not spoken about so far, is called loan service provider. Who are loan service providers? This is where magic happens. This is where lending truly becomes a feature. Now think of the various kinds of companies that you're already working with. Let's say you're a restaurant that's working with Swiggy. Swiggy has all the data on how much orders you get, what's the volume, what kind of money you make in a month, right? Now they can become a loan service provider by tying up with different financial institutions, tying up with an account aggregator, and offering loan to their restaurant partners by saying that, hey, use the data that I have, that you have with me, which is the Swiggy data, which is the true revenue data, match it up with your other kinds of data and get a loan on the Swiggy partner portal, right? Now this is just one example. They companies like these that are in the different sectors, let's say you were a procurement platform in the food processing sector, right? Imagine the power that you have now to say that all my customers, I will make sure their best interest is in mind, and I will give them the loans that they need to for their business to flourish. And if their business flourishes, my business automatically flourishes. This is where the syndicators are going to face the biggest challenge. The out and out DSAs, or the direct sourcing agents whose job was to just give a loan, are going to find themselves in a place where, like, what is my value add, right? What do I truly give to this person that somebody else is not going to be able to give? I'm going to give you some examples of who can these loan service providers be. These Khata book type apps, these neobanks, the payment gateways of the world, the Razor Pays of the world, right? These agri-tech platforms, the B2B e-commerce platforms like Off Business, Moglix, all of these people who have a lot of proprietary data already, add lending as a feature, and you truly have an ecosystem where money is going to the right people.
Siddharth, is this how cred finally starts making money?
Well, I mean, cred is still offering loans for the. Actually, I don't know. I've heard cred's loan book is actually swelling, and they're giving out loans. What I don't understand, and this is something that we can sort of have a discussion on at a later point in time. They've been saying that we're targeting the 1% of India, the cream crowd of India. I'm very curious on what is this cream crowd taking loans for. I'm hoping they're not taking loans for mobile phones and TVs and whatnot. I'm hoping they have the purchasing capacity and the sense to not overinvest in these kind of things and only buying what they can truly afford. So I'm very curious on where the cred money is going. If it's going into productive things, I think cred is going to benefit from this.
Dude, if I'm not mistaken, the cutoff point for the 1% of India is something like 70,000 rupees per month. So you would still need some kind of financing to buy phones, to buy your TV, to buy a washing machine and all that stuff. So it might actually be that. I have no idea what it actually is, but it might be that.
Yeah. So these loan service providers are going to be the new sourcing agents, for lack of a better word. And it's going to be as simple as somebody coming in, let's say a vegetable vendor who's using Khata book or a UPI app for that matter, right? Like they are using PhonePe or Google Pay, right? Google Pay has this option to say that, hey, if you want a loan, apply here. When you apply there, your data is automatically shared. Within 30 seconds, the loan offers come in. You decide which loan offer you want to take. You take that loan offer and you are good to go. And the deduction can also happen automatically, by the way, through, on a daily basis if need be. So what this will also lead to is different kinds of credit products. The flexibility in credit products is truly going to happen now, because in the digital world, it's easy to build and launch these products versus what it was in the physical world. All of this is going to be automated in the ideal world. The demo that the iSpirit team showed, it took 4 minutes from registering for a new, registering as a new user to actually getting that loan, even if you had not set up account aggregator. So once you have all that set up, the time to get loan is going to significantly reduce. If you can now give people loans who were originally getting at 300%, if you can give loans to them at 30-35%, 2-3 things happen. One, at 30-35%, which is completely automated, it makes sense for banks to get into this huge market. The other thing that happens, it's 10x lower in terms of rate of interest for these people to now build a true business. They can now actually use the money and grow their business. And that's how we get MSMEs included. This entire work, as I said, I'm impressed. You probably heard it in my voice. You'll probably see it in the video. I am so impressed by what we've pulled off. And for the longest time, these things have been spoken about for the last 4 or 5 years. And you did not believe this could happen, right? But today, when I was using the account aggregator app, I realized that it's there. It's not too far when we are going to get 30-second loan offers, right? And it's the amount of opportunities that it opens up, not just for lenders, but as I said, loan service providers. So all these people who are working with a segment with proprietary data, lending as a feature is truly here. So that's a new opportunity that opens up. NBFC license for account aggregators. Setu API, the company that was building fintech infrastructure called Setu, that got acquired by Pine Labs like last week or a couple of weeks back. They got the account aggregator license. Amongst more people are going to get the NBFC account aggregator license. So they're going to build digital infrastructure that will help, and they probably get paid for every transaction. So they're going to get benefited from it. New kinds of loan products will come up, which basically means new kinds of NBFCs can come up with targeting a certain kinds of loan products, so targeting a certain kind of section of the economy. Those are going to come up. It's truly going to open up the MSME lending sector in India, and it's going to be beautiful. I can't wait.
You are so excited.
Yeah, I'm a nerd for all kinds of things when it comes to lending, and having gone through 3-4 hours of videos of iSpirit demoing the product, answering the nuanced questions, it was beautiful. And to be honest, I still haven't done justice to the kind of use cases and to the kind of flexible products that are going to show up, right? Invoice financing is truly going to open up because of these kind of products, right? Because if you were a GST app, like let's say Clear Tax, right? They help a lot of companies with GST. They can now bake in a loan product very, very easily, right? Because the infrastructure is there, the APIs are there, the lenders are waiting to give money. You just need to pull it all together and make it as an offering for your customers. There's so many kinds of these loan service providers that are going to make embedded finance or embedded loans truly a reality in India.
I have a question. So right now, if I want to add another working capital loan or whatever loan to my company, right? I have to take an NOC, which is a what does NOC stand for? Thank you. Non-objection certificate from my existing bank, which basically says that, hey, we do not have any outstanding problems or outstanding loans or something like that with this guy. This guy's not a defaulter. We're okay with you also lending this guy money. But in your case, how will that whole NOC thing work with that?
I am so glad you asked that, because I'd actually missed an important part of how the traditional world is going to look different from the new world, right? The traditional world was lend and forget, which is what your bank is doing, right? They're giving you the money and they're forgetting about it till something different happens, which is either you come back for top up, or something you've stopped paying. That's when they come back again, right? What used to happen was a balance sheet based lending used to happen, which was every year you make your balance sheet, you give it to them, and you say that I need a top up. That's when you used to get a top up. So it was a balance sheet based assessment, which obviously balance sheets are made once a year. These were obviously high ticket size loans and high lead time with physical documentation and everything. But in the new world, which is called lend, monitor, and collect, what's going to happen is, one, this is going to be high data touch. So it's not going to be just balance sheets. It could be your cash flow statements, and cash flow statements are more real time, your bank statements and invoices and stuff like that. So your cash flow statements plus your understanding of what your ticket size demands are, so they can give you SASE size loans. And the other thing that's going to happen, the monitor aspect of it, is on the account aggregator, what the bank in your case is going to do is going to say that, hey, I want access to this bank for the next 1 year, and I'm only going to check if more money is coming in, or if significantly irregular activities are happening, if the money is being transacted or is being sent to another account and stuff like that. In that case, they probably don't need an NOC anymore, because they have access to the data to make that decision, and they're going to probably build systems that are going to flag these things automatically, which will say that, hey, you already have a loan, and even before that, right? Like this is the final stage I'm talking about, which is the money hitting your account. Even before that, when the account aggregation data sharing happens, there are two kinds of players in this. There is the financial information user, and there's the financial information provider. In this case, both these are automatically talking, right? So whoever is using your financial information already knows that you have a loan from this account. So technically, they will also not like to, over give you over leverage, because both the loans then become in danger if you're over levered, right? So those kind of things can only happen if the entire thing was digital, which it will now be, because you can continuously monitor data now, real time data, rather than waiting for a year to see that, hey, who did you take another loan from?